If you're a business owner or you have rental properties or a side hustle, you need to pay attention to the $75 rule. The $75 rule applies to certain business expenses where you don't need a receipt. Many people apply this rule to all of their tax deductions, and if you do that, it can result in a significant loss of tax deductions and even make you incur penalties. Per IRS Reg Section 1.274.5C23 applies a clear explanation for how to treat the $75 rule. Now, this rule applies to three categories: business travel expenses, vehicle expenses, and gifts. All of these that cost less than $75. Now, what this rule says is with these categories, you technically don't need to keep a receipt if an expense is less than $75 and falls within one of these categories. Now, it's worth noting that your bank and credit card statements do not count as sufficient documentation for other expenses. So in the event you're selected for IRS audit, don't come to the table with just a bank statement or a credit card statement. You'll need a receipt, an invoice, or some sort of documentation showing the purchase. While you technically don't have to keep your receipt for an expense now under $75, it's worth noting that you should probably just get in the habit of doing so or uploading it to some sort of accounting system or saving it to your file and then tossing the receipt. So at any time, you're able to recall it in the event you need it, like in an audit. So if a business travel expense, vehicle expense, or gift expense is less than $75, you don't need to keep a receipt.